Everyone, today I'll be telling you how to select a mutual fund. So basically, before selecting a mutual fund, first let you know that there are different types of mutual funds. So the first mutual fund type is open-ended mutual fund. In open-ended mutual fund, basically the funds in which you invest, you can invest at any time which you want. These funds basically, if you want to invest today, you can invest today also. If you want to invest after 6 months also, there is an option you can invest after 6 months also. In close-ended mutual funds, in which there is a particular amount of deadline after which you won't be able to basically do a fresh investment. You can get your investment by someone who is selling the same in the market, but you are not able to get a direct investment in that mutual fund. So you should invest in this closed-ended mutual fund before the deadline. So now there are different categories which are formed in terms of types of mutual funds. The main are debt mutual funds, equity mutual funds, and hybrid mutual funds. In debt mutual fund, basically the mutual fund companies invest in government securities, government bonds. They also invest in corporate deposits. In equity mutual funds, they basically invest in stocks. It can be a sectoral fund also, and it can be a non-sectoral fund also. In sectoral fund, basically the companies invest in particular type of sector. Let's say a equity mutual fund for infrastructure sector. So the companies in which they have invested will be all infrastructure based companies. For non-sectoral funds, it will be investing in different types of industries and sectors and all. So it's very diversified type of equity mutual fund investments. For hybrid mutual fund investments, it's of combination of debt and equity. So in this mutual fund, basically a particular percentage of investments is done in debt and particular percentage of investments is done in equity. So if I want to categorize these three types of mutual funds in terms of high risk, I would say equity mutual funds has the highest risk, followed by hybrid mutual fund and then debt mutual funds. If I want to categorize these mutual funds in terms of returns, like expected returns, the returns can be varying based on the market scenario. So I will feel that equity mutual fund can give you the maximum amount of returns, followed by hybrid mutual funds and then debt mutual funds. Because in terms of returns, equity mutual funds are investing directly in equity, in which is very volatile, due to which the amount of return one can generate can be very much high. As far as hybrid mutual funds go, it is both of, I would say, a combination which will help to basically reduce your risk, because just in case your equity which in which the mutual fund company has invested doesn't perform or it went very down, so to back it up, because there is an investment in debt also, like investment in other government securities, bonds and corporate deposits, the overall NAV, that is the net asset value of the mutual fund, won't be affected that much as compared to if the mutual fund is only equity based mutual fund. The third is debt mutual fund. So in debt mutual fund, the basically the amount of return is not as high as one can expect from other types of mutual fund, but it's very much secure. The possibility of getting a return in the range of, let's say, I will say 8.5% to 11.5% range is very high, and most of the funds are performing in this range only as far as debt mutual funds go. So what will be your investment strategy for mutual fund? So what I will recommend, that you should invest from a long term perspective. I will suggest that if you invest at least 5 years, or at least, let's say, 6 to 7 years, you will be definitely getting a very good return. What I will suggest, that you basically find a fixed deposit calculator with the aim that I want to double my money. So let's say if I have 2 lakh rupees today, how much years it will take to double that money? like how much years it will take to make that 2 lakh rupees into 4 lakh rupees. So if you get an answer that it will take 7 years to do that, your aim should be that if I invest in mutual fund, I should double my money at least in 4 to 5 years. So this is the investment strategy which I think we should follow. The second key investment strategy will be diversify your investment. Don't invest only in one or two mutual funds, because in case it doesn't perform, your investment portfolio can hit to a larger extent. If you diversify your investment, then though the returns won't be very high, but the returns won't be very low also. It will be somewhere in middle. So this will help you basically to reduce your risk and also safer your investments. The third investment strategy will be invest only once, or do systematic investment plans. So let's say you got some like a big bonus from your company where you are working, or you have made some very big money by doing some business, or some any money you have got from somewhere else, a huge amount of investment, then you invest straight away. Or if you don't have that much money, a big amount of money, and you want to still do a good amount of investment in mutual fund, then the second best method is definitely to go for a systematic investment plan. These days systematic investment plans just starts at rupees 500 per month, which due to which every one of us can afford to do a systematic investment plan. So if you start today by investing 500 rupees every month, over a long period of time you have invested a good amount of money. Let's say if you have invested 500 rupees a month, and let's say you want to do that for next 5 years, so 6,000 rupees a year and 5 years, that means you have invested 30,000 rupees. Then what you can do, like if you had invested the same thing in a recurring deposit, a particular rate of interest, then how much money you can generate at the end of 5 years, you should at least expect that you get at least 10 to 20% more from the recurring deposit if you invest in mutual fund. Then only the purpose is satisfied, according to me. The third thing will be you should regularly check your investment net worth. Just by investing once, your task is not ended. You need to regularly be updated with what is the current performance of your mutual fund which you have selected. And also fourth thing will be look at the expense ratio. Basically what happens, like whatever the returns you get, it is then deducted by the expense ratio. Let's say after investing 80,000, at the end of 1 year your 80,000 has become means you have got a return of, let's say, 15%. So in 15% return in 80,000 investment, you basically have got a 12% interest. But if there is an expense ratio of let's say 2%, they will deduct 2% from the total amount. So 80,000 plus 12,000, that is 92,000. So they will deduct 2% from that 92,000. So basically you will be losing at around 1840 rupees from that, because expense ratio is a percentage which the mutual fund company charge, because they also have to pay salaries, then other expenses which are involved in terms of paperwork and all, which they charge after the return which is generated. So the lower the expense ratio percentage, the better returns they are going to get eventually. So what are basically the benefits of mutual fund? So from a long term perspective, I will say that if you invest for more than 1 year at least in mutual funds, the interest which you get is not taxable. If you invest in fixed deposit, this was not the case, because in fixed deposit they charge you a TDS. Let's say you get a fixed deposit of 8% for a 2-year duration, let's say for that example. So whatever money you have invested, you won't be getting returns in terms of 8%. You will be getting returns in terms of, if you are in a 30% tax bracket, only 5.6%, because they deduct 30% of the interest, like this 8%, which is 2.4% from the total interest which you are going to get by investing in a fixed deposit. So in case of mutual fund and also in equity, you are not required to pay those taxes, so which is a good thing according to me. If it is definitely it is a safer option as compared to investing directly in stocks, because in this you are investing in different amount of stocks and different kind of debts based on the mutual fund you have selected. So your investment is diversified, so your risk is definitely is less as compared to investing just in few or only one stocks. Third good thing is that you also get dividends also, just like you get in investing in equities. These dividends are passed on by the investing companies to the mutual fund companies and then to the end investor. The fourth thing is that there are a lot of options these days as compared to a few years back, because there are many mutual fund companies and there are various types of funds which they have brought out in the market for the consumers. So now, where to find the right mutual fund? So for that, I will recommend you to visit to valueresearchonline.com. This website you will be able to get to know about various types of mutual funds which are available in the market. You will be also able to compare various mutual funds based on different parameters such as returns, risk, ratings and expense ratio and a lot of other factors. So stay subscribed to this channel. I will let you know how to basically find out the right mutual fund for your investments. So thank you for watching this video, and if you like this video, please hit the like button and please share the video if you found it to be useful for your friends as well, and subscribe to your channel, and if you have any queries you can comment for the same.